Okay, so we assume that the only way to deal with the inflation problem is to risk a recession problem. In fact, officials in the Federal Reserve have been repeatedly quoted as saying that they expect a mild recession is the only way we can reach the 2% inflation target. And that's because of the tools that they have. The tools that they have been aimed at making it harder to borrow money, thus making it harder to employ people at the same rate, thus throwing people out of work, weakening the bargaining power of labor, which is a goal of theirs because they think that that's going to drive down wages and then prices, even though prices have been rising faster than wages, even though wage growth has only contributed to about 7.9% of the inflation. Their whole policy is geared towards that 7.9%. And it's not only anti-worker, it's also just very risky. And we're basically assuming that we are going to deliberately induce a mild recession. We could hope it's mild, or we could consider other options. Here are some other options. 3 other options: monetary reform, investment in worker cooperatives, public investment in worker cooperatives, and decarbonization. Now, when I speak of monetary reform, what do I refer to? Basically, we have a fractional reserve banking system. So banks loan money into existence. If you deposit $1,000 at the bank can loan out $900 to one person. It can loan out $810 to someone else, $720 to somebody else. In effect, with a 10% reserve requirement, the bank could loan $9,000 into existence using the seed money that you put in through your deposit. And the kicker is they can tell you, the depositor, and all of the borrowers that you all can withdraw every penny out at any point that you wish as hard cash. And the reason why it works, when it does work, according to John Kenneth Galbraith, the way he put it is, it's because people believe and trust that the bank is not doing what it is in fact doing. So we could base our whole financial system on trusting an illusion, or we could put it on a more solid footing. We could make it a much more stable financial system connected to our payment system. We could solve the problem of too big to fail, all of the regulatory issues that we have. I know this sounds like a big sell. It sounds like I'm claiming a lot of benefits, but no, we actually could very easily with one big regulation, one simple one, which just says this: when a bank has money, when it is guarding money, it can charge money to guard money and not gamble with it. Or if you want to make interest on your money, you can give the bank permission to loan it out. But when it's loaning out the money, it's not creating new money in a full reserve bank. Rather, you are giving the bank permission to loan out your money under the understanding that you cannot touch that money. You cannot withdraw a penny from your savings account if you want to make interest at the end of the year. You can't draw out a penny while it's being loaned out. So the money is changing hands. A different person has it for a period of time. It is not being used to create new money the way that fractional reserve banks currently do. Now, in order to do this, in order to bring this stability to the financial system, you would have to also expand the money supply, because forcing banks to stop loaning out nearly as much money will contract the size of the money supply. And the whole point is you have to have balance. So the way that you achieve that balance is by having the United States Treasury and a nationalized Federal Reserve, for instance, or a nationalized Bank of England, for example, with the sole authority to expand or contract the money supply. And I think that the best way to do this, to make sure that it is only expanding or contracting the money supply as much as it ought to, is to tie it to a K% rule in years of normal GDP growth. So if you have normal GDP growth rates, the only percentage that the money supply can be expanded is the same percentage as the growth in GDP. Why? So that way there's enough money circulating in the economy for people to purchase the goods and services that are available to them. There isn't too little, which would put people out of business. There isn't too much, which would drive up prices. And so that rule makes sense in years of normal growth. I differ with Milton Friedman on a lot of issues. And on this, I would differ with his idea of applying the K% rule across the board, because in my view, if you have a negative 1% GDP growth rate one year, the last thing you want is for the central bank to take money out of circulation. That's the absolute last thing that you would want it to do. On the contrary, you would probably want it to induce a little inflation to, at the very least, counter the deflationary trend in the economy. So anyway, that's point one. This is not only going to solve for inflation, according to IMF studies, which granted looked at a slightly different version of the K% rule, I grant you that, but it's definitely going to help us deal with inflation, certainly in years when the economy is growing at its normal rate. We can certainly prevent a lot of monetary pressures that cause inflation by having one agency which is obligated to only expand the money supply as much as GDP is growing. And moreover, it also solves for public and private debt. In the short run, it will help us dramatically reduce our debt to GDP ratio without austerity measures. In the long run, it will also help us entirely over the next 4 decades, according to the IMF study. It will help us pay off our entire national debt, and will also help us dramatically reduce the amount of private debt in our economy, which, if anything, is a bigger issue. Mind you, the debt to GDP ratio is currently 124%. We aren't going to solve it through austerity, or if we do, it would be very painful. We could solve both inflation and debt painlessly. I know it sounds hard to believe, but look at the numbers, look at the IMF study yourself. They're a conservative institution, and they even see the potential of this. So next, investing in cooperatives, investing in the cooperative sector of the economy. Worker cooperatives are businesses owned and democratically controlled by the people who work in them. There are numerous studies, which I can link to, which show that they are, at the worst, just as productive as capitalist businesses. At best, they are, even according to many studies, they are more productive. And the same can be said of their survival rates, the same can be said of the wages that they pay. Actually, in the case of wages, it's very clear that during boom times, they pay out better wages. And during recessions, they're able to prevent people from being thrown out of work. And they do this because workers are more willing to take the pay cut, especially when they were getting a better pay raise in better years, and because they really value this kind of job. It's a very empowering job to be in a democratic workplace. And so these businesses are very good at surviving. They're very good at resisting counter-cyclical pressures. And when it comes to inflation, the reason why they're relevant is this, because on the one hand, when wages go up in a conventional capitalist firm, if those wages are rising faster than productivity rates, and if there is no reduction in non-labor costs at the same time, the cost is going to be passed on to consumers in order to make up for the loss in profits. On the other hand, if profits and wages are being received by the same person, then you could compensate yourself for a loss in profits with an increase in your wage income. Now, moreover, what we've seen in this particular inflationary episode is that 53 to 54% of the inflation was being driven by wider profit margins. This is rent seeking from oligopolistic companies that have no connection to their communities. When you have cooperatives, worker consumer cooperatives, and even more consumer cooperatives, then you could also have businesses with more institutional incentives and objectives that are geared towards bettering their communities. And when you have that, the kind of rent seeking, the kind of shameless price gouging that you're seeing is much less incentivized and is much less likely as well. Finally, climate action. What on earth does this have to do with inflation? Two things: food inflation and gas inflation. We are already seeing the impacts of food inflation that have not only been due to supply chain issues, but also due to climate change throughout the world. Now, even if you don't even believe a word of climate science, it's very clear that gas prices have caused a very significant amount of inflation in the 1970s, in 2021, when we started driving again, when the pandemic started calming down, and in 2022 after Russia's invasion of Ukraine. So if we untether our economy to gas, if we untether our cars to the gas pump and our other vehicles, then what we do, among other things, among other very far more important things actually, but one thing that we also do is free ourselves from a massive source of inflationary pressure. So all of these approaches are enormously beneficial in so many other areas as well, and that's why we should pursue them anyways. And if we pursue them together, then we could actually avoid inflation in a way that also avoids all of the terrible cures that are just as bad as the disease. Thanks for listening.